Hi, everyone. This is Jason Bierach of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He's actually one of my old coworkers when I worked at Investing Daily as an investment analyst. He's former chief investment strategist at Investing Daily, where he had a number of very successful paid newsletters. He's arguably one of the top yield specialists in terms of utility stocks, dividend stocks, master limited partnerships. And he recently left and started his own thing at the Capitalist Times with L.A. Gue, and he's got some newsletters going there, including Conrad, Utility Forecaster, and the EIA Income Report on Energy, and that is Roger Conrad. So thank you for joining us here today on a podcast, Roger.
Thanks, Jason.
Roger, our first topic I want to discuss in this podcast is to reflect back on 2013 and look at how the stock market did. It did pretty well, thanks to the endless money printing by the Federal Reserve. Most of the major indexes was up at least 30%. And a lot of people are out there are wondering, is there any value left in the stock market, or everything still, or everything's still overvalued? So I wanted to ask you, do you believe that there are any sector out there that is still undervalued that investors can take advantage of?
Well, I've always kind of looked at the market from the bottom up, and I think there are values there. I think they're not the kind of things that a lot of people will find as they buy their, Vanguard Target Retirement Fund or index fund of their choice. I think if last year was pretty much a market where the averages did really well, I think the coming year is going to be a year where to do well in the market, it's going to be more like the preceding years in the bull market, which began in March 2009, and that is, opportunities in individual companies, and not even so much sectors, but although I do think there are some interesting sectors, for example, energy, which America is now moving towards energy independence, and there's a tremendous opportunity all the way up and down the value chain. But for the most part, the values that we're seeing are in individual sectors. They're in places where, or individual companies. They're in places where people have been down on them. I actually think there's a lot of value on the dividend-paying side of the market, just because of this what I call the taper trade, which it's basically the idea that anything that pays a dividend is a bond substitute, and so therefore generating some selling. I think we do see. I think that's demonstrably false, but I do think it has produced some opportunities. So I think I think we are going to see a continuation of the uptrend. We're still climbing a wall of worry, and that's a pretty important factor in keeping a bull market going. But it is pretty long in the tooth at this point. Like I said, March 2009, we're coming up on 5-year anniversary of that. So I think it's a year or two, just, be very discerning and think for yourself, and don't, necessarily jump on some of these, predictions and strategies, grand strategies that we see coming out, particularly in January.
Yeah, Roger, and if I could add to your point there, I think a wall of worry is a great way to characterize that, along with, this being more of a stock picker's market. I mean, a couple years ago, in 2009, 2010, everything was it was a fire sale. You could go in there and buy commodity producers at a discount. You could go in there and buy, Philip Morris I remember Philip Morris after the 2009 market crash, when they split up the company, I think it was $45, $50 a share, and it didn't do anything for that long, and now it's around $85 or $90. So you've just seen a humongous expansion in market multiples. I think in the last 2.5 years, you've seen, according to David Einhorn in his October 2013 newsletter, he talks about the market multiple drastically expanding for large cap stocks in 2013. Do you think we're going to see more of that in 2014, or do you think the market could correct first?
Well, I think when you see these higher multiples, basically what you're seeing is lofty expectations built in. And looking at the yield side of the market, it's more expressed in terms of whatever the dividend yield is, and you see a lot of people chasing particularly the concept of dividend growth, which is, I think it's a valid concept, but certainly it's affecting market behavior to the extent that favorite stocks, and in the case of dividend-paying stocks, favorite stocks that are growing dividends faster than other companies, we're not seeing many bargains there. On the other hand, the companies that have that have lagged or that have are in a position to accelerate growth, or even in the case of a dividend stock, restore a dividend growth to that dividend. Those are the situations that I think can shine, and there are definitely some good values there. But definitely the popular stocks, those are things to be a little bit wary of. Particularly the ones that say that they're in more indexes than others. There's definitely massive multiple expansion, and again, that doesn't mean the economy can't expand or that they can't produce results. It just means it's going to get a lot harder for those companies to measure up to those expectations, and they come out with a number that disappoints people. You can see a sizable sell-off even if the company is very solid on the inside, and I think that's the kind of thing we're going to probably see a lot more of this year.
Yeah, and to add to your point, Sir Roger, we're seeing stocks like Johnson & Johnson, which are that's a stock that's basically in almost every of the dividend stock indices, and that thing's trading at over 20 times earnings, and I think its forward PE is even higher than that, right? So the market is obviously can go a lot higher, but it just doesn't seem like a value play in my opinion. It seems like there's a lot of capital sloshing around in the global markets right now, whether it's from Europe or China or Japan, and it's leaving these other countries and it's heading to the U.S. because, it perceives it to be safer, and it's going into some of these stocks. That's kind of what I see in the markets, right, in the general stock markets right now.
Yeah, I definitely agree with you, and I think that, there's going to be a lot of sloshing around, and again, it's going to be very important to be a stock picker, not only picking companies that are in good places for future growth, but also that aren't trading at some sort of massive multiple that just makes it impossible for them to, beat their expectations.
Now, Jason just mentioned large cap consumer staple stock like Johnson & Johnson, and then others like Coca-Cola, Campbell's Soup, Walmart, and other good companies that provide constant fixed income for investors, especially the older investors that are in retirement or close to retirement. Do you still think these large cap consumer staple stocks are still a good investment for investors out there, or do you think people should change their portfolio a little bit and focus on other type of dividend stock that provide not only dividend but growth and yet still undervalued?
Yeah, I think a mix of things is always a good idea. And individual sectors behave differently, and sometimes people get excited about a particular type of stock. And like I said, we focus a lot on energy, so I do know a lot more about that sector than I would say some of the others. But it's not always a great buy. I think last year obviously with a lot of lagging, and it was pretty hard to make good returns. You had to really pick pretty good stocks. But I think that I think at any given time, someone who has a portfolio that's trying to collect income off of really needs to own a variety of different investments. And so while I wouldn't completely ignore that sector, I think that there are other places as well. I think we're starting to see some backup, for example, in some of the master limited partnerships that own pipelines and processing and other fee-based businesses that are pegged off the energy business. And so that type of thing gives you a little bit of a different play. And in fact, many of those partnerships are yielding 5-6% and growing at like rates. So you can it's kind of a different calculus maybe than some of these other stocks that you see yielding 2 or 3%, and even some of those that are growing their dividends pretty rapidly. But I think that those are areas. I think it's interesting to look at. People should be looking at some of the real estate investment trusts right now. Those are another group that's another group that's been beaten down by the interest rate thesis. On the mistaken assumption they're just bond substitutes. But we've seen some really nice. I think we're seeing some really nice values, and that combination of yield plus dividend growth across a wide range of sectors, I think, is very compelling. I mean, these stocks are going to follow the dividends up over time. So if you have a company that's raising its dividend 5% a year, it's not going to follow. It's not necessarily going to rise 5% a year, but over time, it's going to track that dividend higher, and you get a nice stream of income as well as a dividend. Those are also pretty ideal for dividend reinvestment, and that's something that younger investors can really do a lot with. Again, with a diversified mix of companies, growing the dividend, reinvesting the dividend in shares, because if you're still working, you don't need the money, but you can really compound your wealth in a big way, even in really conservative names, and that's something I've been doing personally over a many-year period.
Yeah, and compounding, I think you talked about this without actually mentioning compounding. You just named the definition, Roger. That's something that's very key, whether you're young or old. It's very key for long-term investing returns. And, sometimes you're not going to get that bull market in stocks or whatever, and your only returns, essentially, if the market's flat or down, are going to be the dividends. So, even if you build up the dividends for 10 years, the dividends may not look that good, but, 10 years later, you end up with superior returns, and you end up with a lot more shares and then very big yield because you're compounding. And, in terms of, you also touched on this, too, in the income, I fielded a lot of customer service phone calls at Investing Daily, and they took a lot of surveys, marketing data, and I think that's a very important statistic here because, you can kind of see investor sentiment that way. And, one of the main things that people need is because their incomes are not going up, and Obamacare and their food bill and their tuition costs for their kids and their insurance costs and these other things are, seem like they're all going up every year. They need more income because, their wages are not rising. So I think that's why dividend stocks, there's been a good amount of people with money in bond mutual funds, but I don't trust those. And if you look at the flow of funds, you're starting to see money come out, like the retail money come out of the bond funds and flow finally into the stock market, which I don't know if you think that's a topping signal, but maybe we're overdue for a correction, a small one here in 2014.
Well, I think it's kind of rational in terms of the bond market. I mean, I think it's definitely a seller's market for bonds, and what I mean by that is that if you're an investment-grade company, treasurer, you can pretty much go out and sell whatever you need to sell. Verizon sold, they came into the market when they announced the deal for Vodafone last fall with a pretty massive amount and the market reacted somewhat to that initially. But, they had originally planned to issue, I guess, 25 billion in U.S. bonds and then the rest in pounds or in euros, and they wound up selling 49 billion in the United States, and it was weighted towards long-term debt, and it was a very competitive interest rate. So that was a pretty astounding market event that I saw. And I think one thing a lot of people don't understand is that when they buy say a Vanguard or Target Retirement Fund or any kind of institutional money or any kind of big pool of money, chances are there's going to have to be a certain amount of that money put into bonds as an asset class. And as companies have been able to refinance debt at such low rates the last several years and push back, and sell it at really good rates, these pension funds and so forth have had to pretty much just buy whatever has been available. So that's the definition of a seller's market. I just don't think there are bargains out there for anybody really in the bond market. I do recommend a few things, and they're very short maturity, kind of higher quality type situations. But for the most part, I really think it's still all about the equity market. It doesn't mean that equities can't go up and down. It doesn't mean that some of them aren't overvalued. But I think if you're looking for any kind of yield, if you're looking for any kind of value, and of course over time, only equities, that's the only kind of income investment that's going to grow.
Plus,
bonds don't grow value. So that's where the value is.
Plus, you got the management teams, Roger, who are able to adapt to the business environment. You have the CFOs now, right, who in this environment, they have such cheap debt, right, they can buy back their stock. I mean, and if the capital is available, right, even if the Fed is artificially suppressing the interest rates, I mean, the CFO of Coca-Cola or Johnson & Johnson doesn't have any or that much control over that. They're going to just have access to that cheap capital, and they're going to go, either do a leveraged buyout and buy out a competitor and add revenue that way, because a lot of these large caps are not really growing their revenues organically. They have to do it through acquisition, or they're going to go back and buy their shares and manufacture earnings that way and just, reduce the share count. And I think that's what we're seeing in the market right now is that, the CFOs are just being opportunistic with the cheap capital that they have available.
Yeah, and you really probably don't, you don't want to be, the bag holder of this debt at the end of the day. As we get back to a more normal interest rate environment, And that doesn't mean people are going to be wiped out, but it's just it just looks to me like a place where it's, there are going to be a lot more losses similar to what we saw this past year. I mean, it was a bad year to be in the bond market. But, the bond market's pretty huge. That's more money that could actually come into stocks, and that's another reason, I think, to, focus on that side.
Roger, lately you've been writing about interest rate and the relationship between the interest rate and the dividend stocks. Now, when Federal Reserve a couple of years ago lowered the interest rate to almost zero, a lot of investors in the stock market that were dying for yield left the bond market and went into the stock market to look for yield, because if you look at even the large cap consumer staple stock like Johnson & Johnson, Coca-Cola, the yield on those were a lot better than the 10 and 30 years on the Treasury bonds. And so we saw a lot of investors go into the stock market and buy dividend stocks. So I wanted to ask you, can you explain to our audience the relationship between, if there's any relationship between the interest rate and dividend stock? And is it generally better to own dividend stock when interest rate is low, or can you still buy dividend stock when it's high as well?
Well, there's two sides to that, and one, I think you've just explained to some extent the asset rotation, and so people getting the idea, well, if I can get this yield in a bond, why wouldn't I just get that instead of the stock? And that does affect some trading and so forth, but I think it's more or less trumped in the longer term, at least, or even just year by year by the economy. And interest rates are significant for companies as businesses in a couple of ways. One is just the fact that as we've mentioned, they borrow money to expand. Many times they'll refinance their debt. So if interest rates are rising, chances are they'll have to pay more to maintain a certain amount of debt on their balance sheet. It's going to be more expensive to grow, and that means that whatever investment they that they make has to be that much more profitable to make up for that higher interest cost. Well, that when investments tend to be more profitable is when the economy is doing better, and that also tends to be a time when the cost of money is higher. So what we see paradoxically, I think, and what's not really widely appreciated, is that these companies, and again, dividend-paying stocks of dividend-paying companies, they're stocks and they follow, the company's fortunes, they follow the economy. Is that when we've had periods of stronger economic growth and interest rates ticking up, these companies have done better on their earnings front. They've done better paying dividends. They've actually performed better as stocks. So if you look at 2009, which was a period where the benchmark 10-year Treasury note rose about 70%, but it was a bang-up year for stocks across the board, and including dividend-paying stocks. And it was, in fact, one of the biggest years they've ever had. Last year, of course, we had interest rates really started backing up beginning in the early part of May, but it was also another nice year for the Dow Utility Average, for example, up pretty close to 13% for the year. So it's possible. I mean, that was underperforming the broad market, but it nonetheless was a gain. So you can make money with dividend-paying stocks at times when interest rates are rising, provided that those companies are dealing with the environment by growing faster. And going back, and in fact, if you look at the very worst year for dividend-paying stocks since 1984, it was 2008, and that was a year of a very dramatic drop in interest rates in the second half of the year, and so it's important. That's an important thing to remember. I think that they don't move in lockstep with bonds. It's all about earnings, really.
Well, prior to that drop in interest rates, Roger, in 2008, Alan Greenspan, before he left, had also started to raise rates too, so that could have spooked the market. I think one, I'm a big student of financial history. I like looking at the past. Doesn't always, predict the present future accurately. But in terms of the 70s, I think what the 70s taught, stock investors was that, the stock market did pretty well for a good amount of the 70s until, Volcker really started to rapidly raise the interest rates, I think in 76? And, before that, the interest rates were not really that high and stocks were doing pretty good. But then the market realized, inflation is out of control, and and the interest rates just started rapidly rising and being risen and risen and risen. So I don't think that trend is in place yet. So I think stocks can do pretty well until that trend takes place, because I think you highlighted on this is, you have the companies that are a lot more able to adapt to the real economy. You have them, they can fire workers, they can add new technology, they can become more productive through a whole bunch of different ways, and bonds cannot do that. So you have more...
Yeah, exactly. Yeah, go on.
Yeah, so you have a more adaptive culture there in the stock market on the equity side of the underlying businesses. You do not have that in the bond market. And, in the macroeconomic environment I go seeing forward, I just see more and more intervention from the central banks. So, people want something that can adapt to the situation where, if their input costs rise, then management will replace the workers, with the automated software program or robot, or, an example like that. And I think that's why stocks are probably going to continue to do well. Maybe we have a correction, minor one, 10% or something like that, early in the year in 2014. But then I think, we're going to be right back to a bull market then.
Well, let's hope so. I mean, but in the meantime, I do think people can, as we've said, I think people, look at individual companies they own and stay with what's undervalued, stay with what's solid, and try to have a mix of different investments, from different sectors. At any one time, one will be doing better than another. Yeah, I think that's definitely going to be the way to go in 2014, probably on ahead to 2015.
Yeah, I think that's a very solid asset allocation strategy. And on our podcast, we talk a lot about technology stocks and commodities and things like this, but as part of a diversified portfolio, people still need to have a good sound asset allocation strategy. They still need to own some kind of real estate exposure. You mentioned the REITs. For the people who don't want to be a rental property owner, I've heard all the headaches from other friends who own real estate of either hiring a rental property management company and they take huge fees, or having to go by yourself and be a handyman, clean the toilet. There's a lot more benefits then to owning a real estate investment trust, because they handle that for you and you get paid your yield. So, and then, owning other types of yielding investments, whether it be your utilities or exposure to energy, I think those are a good part of a well-diversified portfolio in this environment, because I think the main thing that I get from the stuff that politicians are doing, the stuff the central banks are doing, they're doing crazy things that are, there's really no historical precedent for whatsoever. And we don't know what types of rules they're going to change or not. And I think it's important to have yield exposure in your portfolio that'll smooth out the returns.
Yeah, absolutely. And like you said, this is kind of no man's land. I don't think we've ever been at this point in terms of monetary policy coming out of an event like 2008. Certainly a different approach than was taken in the 30s, and we'll see. But again, I'm pretty comfortable with being in an investment that can grow, because growth is really how you outrun inflation over the long pull, and it's also how you. There's no better sign that a dividend is safe than an increase, than the most recent increase, and that the company can afford to keep paying. So most definitely, I think that's the way to go. I mean, I guess we have an election coming up in 2014. We'll see what comes out of that. Meantime, Washington continues, I guess, the checks and balances keep it from doing a whole lot. So, they're with the growing company, I think that's really the way to go.
Roger, before we let you go, we wanted to talk about the health of the U.S. consumer. Now, we just wrapped up the holiday season, and it was rather disappointing for Wall Street. Retail sales only climbed by 0.2% in December, and they also had to revise down the retail sales for November and December. These stores out there started their holiday discount a week earlier, a week before Thanksgiving, and yet a lot of them missed their fourth quarter guidance. Companies like Sears, Bed Bath & Beyond, Express, Family Dollars, and Macy's had a pretty much a rough holiday. So we wanted to ask you and get your opinion on your thoughts on why do you think the holiday season wasn't very successful this past year?
Well, I think that's real interesting, and if we had a fairly, by some measures at least, a fairly decent second half, or at least third quarter of the year, and then coming in a little bit into the fourth quarter, and there was a sort of sense that things were picking up again. So then we saw interest rates really pick up, particularly borrowing, mortgage rates and so forth. So that sector really seemed to have slowed down, and that had been something of an engine. So I've been really interested the last few months just to see what sort of impact higher gasoline prices, for example, or these higher rates might have on the overall spending pattern, the overall level of economic growth. And certainly in the last decade, pretty much every year there was a period of the year, it was usually in the spring, where people got excited about the economy. We saw interest rates pick up, inflation pick up a little bit, but then that basically was just taking money out of people's pockets and slowing down other areas of the economy. So it really sowed the seeds of its own reversal. So then we'd see in the marketplace where rates had gone up and maybe some of the dividend stocks had sold off. On that basis, we saw a reversal later in the year as that and 2008 to some extent the same thing, but in a much more dramatic way. So I think that's really something to look out for as we get into the rest of this year, because obviously the Federal Reserve wants to slow down the rate of money growth. It's something that is probably not sustainable over a long period of time, although we're really out there, and it's hard to tell where it stops. But if this uptick in rates does slow things down in a significant way, then odds are we'll see some sort of reversal. We'll see some slower growth, and we'll see some troubles, particularly in some of the sectors that have not done very well, or companies that have not done very well in recent years because of the slow level of growth. So I think that's the really big question. I read a little bit about it in Conrad's Utility Investor, and I'm sure we'll write a lot more about it in Capital's Times and our other publications going forward. But it's very much a fluid situation, and I don't think the economy has definitely been a one step forward, maybe a half step backward situation for the past 4 or 5 years, or anyway, coming out of that 2008-2009 debacle. And this could be, what we see could really surprise a lot of people in a big way if we do see that continuation, retail sales weakening and other aspects of the economy weakening. So yeah, that's, I think, the big question, a huge question mark as we get into the rest of the year, probably even more than what the Federal Reserve does, because whatever the central bank's going to do is probably going to be dictated by what it sees in these types of economic indicators.
Yeah, they're saying data dependent, so they're saying they could reduce QE and taper, or they could add more. You're just hearing so many mixed signals. But I think in terms of your newsletters, Roger, I think you're doing a really good job over there with, inflation or deflation in terms of the products you offer with utilities and energy. People are still going to want to, pay their electric bill and keep the lights on, power their smartphones, computers, those types of things. They're going to want to heat their homes with natural gas, and then they're going to want to put gasoline in the tank to go to work or wherever. And, those are core staple spending products that the consumer really cannot cut back on their budget. So I think that's a very cornerstone there of a yield portfolio. And I think you and Elliot do a great job focusing over that, because I know the great job you did over at Investing Daily, and I'm sure you're doing as good, if not better, a job over at Capitalist Times.
Definitely a lot more fun where we are now, but it's thank you very much for those compliments, and it's a pleasure to be on your to be on this podcast with you.
Yeah, so Roger, in wrapping things up, just give our listeners a little bit more of a summary of each of your paid newsletters and where they can find your work.
Okay, well, you can pretty much Google anything we do, but it's Capitalist Times. That's our broad-based publication. Again, it's just capitalisttimes.com, and That's our broad-based publication. We have Conrad's Utility Investor, and that's a monthly publication. We send weekly comments out. And then Energy and Income Advisor. That's our flagship. It covers pretty much the waterfront, all the U.S. MLPs, Canadian stocks, Australian stocks, energy companies in general. Pretty much everything that we used to do in 4 publications at our old employer, we're doing in one here, and with the idea that not every energy stocks are they're better bargains in certain areas at certain different times. So we're very excited about the macro trend in that, and also providing that kind of advice to investors. So we're always pretty much posting something. You can see our stuff on Seeking Alpha, and you can link back to us on that, or just check us out on Google, or come to capitalisttimes.com.
And you guys are doing a lot of webinars too. I see that a lot.
We do a lot of those, so we're trying to reach out to a lot of people in ways that the traditional publishers haven't really in the past. So it's a lot of fun that way.
All right, Roger. Well, thank you for coming on Wall Street for Main Street podcast. Hopefully you can come back on in the future.
Absolutely. Thanks for having me.